General Secretary of the World Confederation of Conference of Transport Research Societies, and he's most recently been researching transport PPPs. So, Alain, your presentation, please.
Yes, thank you, Mr. Chairman. My presentation will be in French and my slides in English, at least in my English. I am not sure of the quality of this English. La planification des transports et des infrastructures.
Now, with regard to programming or planning,
je crois que c'est quelque chose qui ressemble beaucoup à une PlayStation.
Planning,
it's
very much a kind of PlayStation. All the plans which we draw up in the transport sector are plans where we try to contend or play with scenarios and which are similar to PlayStations, and we try to simulate different issues in the form of models and software. Basically, these programming games or attempts have now become a standard, an industry standard. We've even got a scenario which is the regular scenario. We basically know how to implement program appraisals, and when it comes to toll stations, we have an idea of the potential costs and the revenue, and we can also use different indicators for funding and correlations between the funding of other taxpayers and user funding. Basically, this is also the way in which PPPs developed. And we need to check whether these PPPs will change the mechanics or the rules of our PlayStations. Now, of course, there are constraints, funding constraints, and we need to create a socio-economic VA. Last but not least, the environmental aspects need to be factored in. Now, let's look at the various scenarios which we model on the basis of the PlayStation. What does this mean if these scenarios change? Can we still use the old PlayStation, or do we need to create a new PlayStation? Well, first of all, there are a couple of new factors which come into play. There are the public spending rationale, and on the other hand, you have the private industries and private industry and private stakeholders. Of course, they have a different role to play. A private partner has a very objective rationale. They want to realize as much profit and revenue as possible. And of course, the government has certain priorities itself. Again, the government wants to improve public welfare. So, this is where I'm coming from, and now I'm going to posit 3 questions without delving into the details. Of course, you can peruse my study if you want to find out about more details. What are the findings? Well, we got them a while ago. If you look at an investment project in the form of a PPP, you come to the conclusion that you can generate more welfare if you take account of financial return rates rather than if you take socioeconomic return rates. So, subsidies into PPPs. If you've got subsidies in PPPs and if you have a lower rate of subsidies, then you can invest more, or the private sector, the ratio of the private sector can be higher in terms of investment. And on the bottom line is that you will gain more public welfare. or the welfare gain will be greater. All of these issues are not very complex. But on the other hand, there's a second question which comes into play here. If financial IRR is more efficient than the socioeconomic ERR, now, of course, always talking about a PPP, then the socioeconomic ERR, what is the impact on the toll system? Will the toll system be more geared towards optimizing social welfare? Does it mean that they need to focus more on welfare, or would they have to focus more on the profit when it comes to pricing? So these are the issues which I try to deal with in my study. And this is an answer to this question, which is fairly straightforward. This curve gives you the scarcity coefficient of the public funding. And if this coefficient, or scarcity coefficient of public funding is 1, then you get the good or the optimal toll according to 0. So that means you can use the roads for free. But if the scarcity coefficient is greater than, or rather, 1 public euro, which is slightly more expensive than $1, i.e. 1.2, then you need to establish a toll system. Basically, this curve is based on certain functions and calculations, but if you take a look at the French scenario, where you have a toll system where you pay about 6 cents per vehicle and per kilometer, and then you draw a vertical line, a horizontal line, and if you look at the coefficient, then this translates into 1.3 as a scarcity coefficient, as of which you should levy a toll. 1.3. Anything that's higher than 1.3 should be warrant a toll. Now, all of this was very much based on trial and error. And it turned out that it applies to a real system. Now, when it comes to an infrastructure program, of course, we have to issue a hypothesis. There will be a public tender. Various private operators can submit their bids. And we need to develop a couple of toll hypotheses or pricing hypotheses. Then the operators will come in with their bids. And the potential operators will say, well, I will come in if the subsidy rate is X, Y, Z. And the person who wins the bid is the person which usually fights for the least level of subsidies in the public tender. Unfortunately, I need to introduce a bit of arithmetic here. Let's talk about the optimal toll for a program of new infrastructures. The optimum toll provides the maximum of revenue for the operator minus a certain markdown, a very limited markdown, and that is the minimum of the subsidies necessary as a correlation of the maximum of profit. Now, this may sound complicated, but it's not that complicated. But this is a valid function here. Now, this brings me to my conclusion. When it comes to PPP projects, either you have the minimum subsidy rate, which is 0. This means that we can cover everything, i.e. all costs, by the toll. In this case, the analysts says that we can install a free toll road which is utterly unregulated. And of course, then we need to think about ways in which we handle the profit of the operator and how we give back to the society. But that's a different issue. And then this is the second scenario. The minimum of the subsidy is more than the maximum of the profit, i.e. at least 50% of subsidies. In this second scenario, it's better if you use the motorway for free, but this does not rule out a PPP. In the British system, in the PFI, or in the French system, with the contractual partnerships, you can indeed have infrastructures without a toll system, which are still based on a PPP. So that's not a contradiction at all. Of course, you can do this, and it's also rational. It's also in the common vested interest. And then we have the final scenario. If we're somewhere between these two scenarios, if the subsidy is somewhere between 0 and 50% of the costs, and of course always assuming an updated NPV, then we need a regulated toll station, a toll station which is regulated by the government. And in this case, we have 3 families of PPP according to the IRR, internal rate of return. So, of course, these are the findings. And it's not bog normal macroeconomics or run-of-the-mill macroeconomics. Actually, it's a kind of mixed economy. I would not use this term in France because it would be more prone to misunderstandings, but nevertheless, it's a kind of mixed economy here. The final point here I would like to address is the following question. Does this crisis change the analysis, which I just spelled out to you? Now, this is a very straightforward curve. It sounds very complicated, but it's very straightforward. This is a crisis. I'm going to explain to you what it is in a minute. Down here, you have programming, which is based on macroeconomic rate of return. If my investment is not based on the socioeconomic return, but on the financial profitability, and if I also add another criterion, i.e. the updated NPV, i.e. the socioeconomic gain in this analysis, and if we then put all of this into a correlation to the public euro, then this will generate a very good outcome. You need to understand the horizontal line here. The horizontal line gives you an idea of the budget constraints. And during the crisis, of course, we'll have less fiscal revenue, and this means we'll have a downturn here. Moving to the right side of the chart is the bog normal situation. This is where we need to organize our investments over a period of several decades in order to well, we need to look to the socioeconomic rate of return in order to assess whether we can recommend a certain program or not as experts. Now, this is on the right-hand side. Now, let's move on to the left-hand side. With the public budget, which is facing increasing constraints and scarcity, well, this is the scarcity coefficient here. If you move on to the left, you see this very graphically. And the potential revenue which we can generate if we switch from IRR to macroeconomic or external rate of return in terms of gain or welfare, then profit is becoming more important up until 20%. My main message is a very simple one. Basically, the crisis can bring a major advantage, i.e., if you carefully select your investments, if you prioritize your investments carefully and program them carefully, then you can be more successful than with traditional methods. This morning, I had a slight delay whilst waiting on the plane, waiting for my plane, and I carried out a small computation here. Investments with regard to the railway system in my country, 200 million. Amount to 200 million. And I just thought, what if we were to rewrite history? So certain investments have been made over recent decades. And if we thought that the crisis had hit, let's just think for a minute, that the crisis had hit home 5 or 6 years ago. We've got this investment here in the medium. 130% of benefit gains, of welfare gain is produced as compared to the destroyed welfare. And now let's just suppose the following. If I only take a third of these investments, because of the scarcity and constraints I'm faced with, I can only pay 1/3. Affluence gain, welfare gain, and put this into correlation to the destroyed welfare gain, and that's a value of 60%, between 60 and 70%. And if I now take the best third, i.e. in the upper range of this curve, then I have a clearly better or higher value. If I take the best third, this brings me to 300%. And even although this may sound like a contradiction to other contributions which have been made here, if we make responsible decisions if we want to make responsible decisions during the crisis, then we need to make
Alain, thank you. An example there of the analytical French approach, which has given them some of the most effective toll roads in the world. Let me move from looking at how you might get road pricing to work in terms of improving the investment from the user or from the private sector. Let me move over to aviation and Walid Youssef. Now, Walid was advisor to governments on aviation at the International Finance Corporation, which is the private sector arm of the World Bank, and he's Chief Strategic Officer at the TIV Airport Holdings of Turkey. And it's interesting in aviation, Walid, that while we associate it with the private sector, most airports are still very much in the public sector. And similarly, we've got issues, a very sort of troubled decade or two in some areas about privatizing national airlines and so on. But your presentation on aviation.
Thank you, Mr. Chairman. And I hope that changes very quickly so that most airports are managed by private operators. But so that my comments can be placed in the right context, I would just like to spend a minute or two introducing TIV Airports. We were established almost 10 years ago, and for the purpose of developing and operating Istanbul Airport, Istanbul Ataturk International Airport, following a competitive BOT bid. We are a publicly listed company that is owned by its founding shareholders, which are 3 prominent Turkish construction companies, and since a successful IPO in 2006 by a number of institutional investors that include Goldman Sachs and the Islamic Development Bank. So we're a different company than our peers like Fraport or Amsterdam or ADP, in that we don't have a public sector legacy. We don't have shareholders who are from the public sector. And as a result, we don't have any explicit or implicit government guarantees in our financing. And I think the gentleman yesterday from Fraport made that point when he was asked why the cost of capital for them was relatively low. We have grown in the last 10 years, as this slide shows, and will operate by the end of this year 11 airports in 5 countries. Last year we handled about 36 million passengers. We also, because of the nature of the markets that we operate in, we are an extremely vertically integrated company. So we do everything from design, construction, operations, also ground handling, duty-free, and so on. Because the local capacity in the markets that we operate in is just not there to the same level that we would require. So we bring the whole team with us when we go. Focusing on the subject matter, I think it's important to recognize that air transportation is one of the most important catalysts for economic development, and that congestion in the air transport system leads to higher user costs and is a major constraint on trade, mobility, and economic prosperity. I don't think I need to make that point at this conference. Also, as Mr. Garber mentioned, adding airport capacity and others, adding infrastructure capacity in general is difficult and very time-consuming. We see that Frankfurt only recently got their approval for a runway after 12 or 13 years. London is still struggling with adding additional capacity. So airport operators must really look beyond the time horizon and beyond the current crisis that we're facing in order to continue to meet the demands and needs of our stakeholders. I also made the point in Q&A that I don't believe that the crisis will fundamentally change the perception of value of air travel. So people will continue to fly. And there have never really been any substitutes for air travel that have emerged. In fact, the industry has reinvented itself through low-cost carriers, and that has in turn generated additional demand, additional traffic for demand that was previously untapped. So air transport has proven itself to be extremely resilient, whether it's a war, whether it's a plague, whether it's a recession, or any other external shock. And there's no reason to believe that the market will not recover fully in years to come. I would like to present this graph, this chart, which shows, this table, which shows the results of an ACI Europe study conducted in 2006. That's unfortunately the last time this study was updated. And it shows, in general, that airports in Europe have continuously invested approximately 8 billion euros every year in annual capital investments. And that's expected to continue in 2015, and the number might be actually a little bit higher in this horizon. But a more recent study that was issued at the end of last year is really alarming. This study was done by Eurocontrol, and it is the most recent study on airport capacity and demand. And it concluded that air transport demand will far exceed capacity by the year 2030, which was the horizon of the study. The study concluded that between 19 and 39 European airports will experience congestion of more than 8 hours a day. And this will impact between 6,300 and 19,200 flights a day. That 50 to 70% of all flights at European airports will be affected by this. And it also found that the rate of congestion will increase over time, and in fact it will double between 2025 and 2030, the last 5 years of the study. So how do we deal with these challenges? There is no question that significant capital investment is required for airports and air transport infrastructure in general, and that this important sector is necessary for the economic development and for our economies. We also know that the private sector has proven itself to be a much better developer and operator of airports than the public sector, and there are many successful PPPs around the world to prove this. So in my opinion, the smart thing to do is for the governments, since they've decided to become Keynesian, is to encourage even more PPPs in the airport sector, which would allow stimulus spending to be directed towards this important sector, and ensuring as well through the participation of the private sector that the projects are executed and operated in a cost-effective manner. I would remind, and my colleague Mr. Rubio has mentioned, that PPPs have always been about the proper allocation of risk between the public and private sector. and each party has a certain capacity to absorb certain aspects of the risk. And I think it's clear to me, at least, that the private sector is much better at designing and constructing and operating and financing and commercializing these assets. But in the last 9 months, a number of things have happened. First, that affects liquidity of both debt and equity, which has declined. The financing terms of conditions have become much more onerous. Leverage has decreased, so that there is more equity required for projects on a project finance basis than debt. And of course, short-term demand and traffic has dropped, which ultimately means that these projects have become less bankable. So looking forward, I believe that the public sector has an important role to play in fixing this imbalance. First of all, from a policy perspective, it's to ensure that there is a commitment to closing the gap between the capacity and demand by encouraging additional investments in this sector. In terms of process, to speed up the process and decision-making that is required for both tendering and decision-making. In terms of the right mix, to encourage public-private partnerships. And in terms of financing, to facilitate access to reasonably priced capital through the public sector contributing its borrowing strength. And I think there's an important point that Professor Mackie has made about delinking the management of this infrastructure and the financing of that infrastructure. On the last point, the public sector is able to correct this financing imbalance and should, as a result of its contribution, expect a higher return, either through higher concession fees or through lower user charges to further stimulate air travel. And I believe that the contribution of the public sector through better financing will far outweigh the congestion cost that is associated with the increasingly congested air transportation sector. Thank you very much.
Thank you, Walid. Well, Nicholas Rubio, who's the Director of Business Development at Sintra, has an outstanding track record with Ferrovial and with Sintra in attracting private investment into, particularly into the roads space, although Ferrovial are now in airports as well. Nicholas, your view on how we can make the PPPs and private investment in infrastructure more attractive in these difficult times?
Thank you very much. Probably I will start making some comments on the way we see the private sector role in developing infrastructure, which I believe is not always understood. Many times we refer to the private sector as private companies that can build an infrastructure or can operate an infrastructure. We believe that the main activity on private development is precisely developing, is investing in infrastructure and making a return on that investment, which is not the same thing as developing a construction activity or an operation activity. Now, as the interesting paper that Peter Mackie and Robert Cochrane presented says, and as I mentioned before, funding is not anymore the only reason for the private sector being developer. So you were in your paper suggesting that nevertheless there are other advantages of having the private sector, as is the design, build, construction approach, is the long-term operations. What we believe is that in order for the process to work, we need the right alignment of interest, and those private activities on construction and operation do not work in the same way when the private sector is risking its equity in a project or not. So what we believe is that the investment of equity in infrastructure development is a key element that brings rationality, that brings efficiencies to all those activities, as the private sector says. Our business is about creating value for investors. which is, by the way, we believe, contributing to the global welfare, and it is creating opportunities for investment for a number of funds that have this long-term view, that are looking for long-term cash flows, not only pension funds, but sovereign funds, insurance companies, and we believe that there is a market for all that. Now, going down to the details, if I may, which is the actual problem? What is the impact of the actual crisis? What we are experiencing is a combination of factors. There is an increase in the costs and a worsening of the conditions of funding of projects. And there is an increase in cost and a scarcity of resources of equity, both third-party finance and equity. No? What is happening on the financial markets? It's very easy. I mean, I think there is agreement on what is happening. The capital markets are not anymore available for financing infrastructure. The monoline insurers have run out of the market. The only available source of financing, or almost the only for the time being, is the banking sector. And in the banking sector, we're coming from a situation where for each deal, a large deal, there were 30 available banks to a situation where there are 10 available banks. The result of that is being that the conditions are tougher. I know there are bankers in the room, but I remember a famous comment by the chairman of a Spanish bank on the crisis of the 80s, when he was asked by a journalist, Mr. Chairman, how were you able last year to increase your profits in the midst of this crisis? And his answer was, I could not avoid it. So yes, we think that as a result of the reduction in the number of banks in the market, banks are increasing their prices and are worsening their conditions. And that is reducing the ability of projects to be leveraged. I think it is interesting, and let me enter into this detail, to mention, to give us an example, it is interesting to see how different public authorities are trying to solve the issue. It is interesting for me to see what the Treasury, the UK, the HM Treasury is doing, where they basically planning to take the temporary role of a banker. So they are basically planning to complement the other banks on a pari passu basis and just making a syndication achievable. The reaction we have seen from banks is not very positive to that, precisely because it is a competition to banks, because when there is a limitation in the number of banks, then banks dictate rules. If there is a public authority that is willing to come and take a seat, even if there is not enough number of banks to finance a deal, then that is bringing, I believe, is going to bring costs down. Now, obviously, the other problem and the consequence of the scarcity of third-party funding is equity has to increase its share in its investment in projects, and at the same time, equity costs are going up. Equity costs are going up for two reasons, we believe. One of them is, in general terms, equity risk premiums in the market are going up by anywhere from 100 to 200 basis points, 1 or 2%. But on top of that, there is a change in the nature of the investors. Greenfield projects were traditionally being developed by pure developers, many times linked to construction companies, and were able to invest on more aggressive terms than more long-term investors. What is happening now is that these investors, these primary developers, are needing the support of more long-term investors, funds, to come into the picture and invest as well up front, and that is driving as well costs up. simply because the target IRRs of funds are higher than target IRRs of developers. No? So there are three reasons why equity developers, the private developers need that, are going through trouble in these times and are facing problems to continue financing deals. One is simply the scarcity of equity. Traditionally, our company has been in this business for 40 years, and the last big capital call we made was 10 years ago. From then, we've been developing our business with our own concessions, and what we've been doing is releveraging our existing concessions. That is not anymore possible. The market does not anymore allow you to releverage, so you have to find other ways of finding equity, and equity is scarce. So that's the first reason. The second one is that banks are looking at developers and are adding up all the debt of their investments, and the central banks are putting limits to that global debt of developers. So, for instance, looking at Spain, the 6 top developers all have the same challenge, are facing the same challenge, is that the Central Bank of Spain is fixing a total amount of risk that banks have to have as a maximum with each developer, and when adding up the debts that all those developers have in their different projects, they go to very high figures, which go beyond the limits that the central bank is setting. And that is there's a misconception there, because you're looking at those developers, most of that debt is encapsulated in projects, is non-recourse debt. So it should not be that big problem that the total amount of debt goes up. So that's the second reason. And the third reason is accounting. Accounting has been changing in the last years, and today what we believe is that accounting is done in a way that does not reflect reality. Together with Macquarie, we invested in Sydney Airport 5 or 6 years ago. We were showing big losses in the 3 years after our investments, and we were able to sell our investment with a big profit 3 years after. So that accounting was not reflecting what in reality was happening in the asset. I'm sorry, but that is the point. And just to finish, what we believe is that we're going to see a change in the model. The need of the economy is that there is a development of greenfield projects. But precisely because there is a scarcity in equity, what we see is funds willing to invest in brownfield projects. So what we believe is that what is going to happen is that primary developers, more industrial developers, are going to continue investing in greenfield projects, but are going to be willing to exit those greenfield projects as soon as possible, as soon as they start looking brown. So this is what we believe is going to happen in the future, that probably the term for private investors remaining in projects is going to be shortened. We were awarded our first concession back in 1968, and we were there until the end of the concession in 2003. I don't think that is going to happen in the future. If we want to keep growing and keep developing our business, we'll have to exit projects ahead of time.
Nicholas, thank you very much. Some of the issues raised there point me towards Matthew from the European Investment Bank. And Nicholas touched on the issue of the monoline companies whose business model has virtually collapsed, who would wrap the bonds for higher quality infrastructure investment. Are you looking to take over that? Well, that's obviously a very important function which should be replicated somewhere now. Is it for an international institution like yourself to do that, Matthew? And what's your response to some of the other issues raised there?
Thank you, Chairman, and thank you to Nicholas for relieving me of the duty of describing what's going on in the market, because I think he did a very good job in explaining what the situation is and why things are looking very different from what they looked like, say, 1 year ago. I'll get back to the issue of wrapped bonds at the end of my presentation. I mean, it's a very interesting time, obviously, to be looking at this changing world of PPPs. We have we have the past vision of a very large promise made by the PPPs, and which was at least partially fulfilled, at least according to those places where there was more experience, which was that, you know, this was a way to harness private finance. We needed that because the amounts of investment to meet the needs of the transport sector were simply so staggering that you could not imagine that the public sector would be able to do the whole amount. On top of that, harness the private sector skills, which was very adequately explained also, I think, by Nicolas Rubio. And all of this in a context where value for money for the public sector could, in fact, be ensured by a well-constructed chain of contractual relations, negotiations, and ongoing relations with the operating consortia. Of course, there were and remain a few key issues with the whole concept. One of them is that this PPP promise is unequal, depending on the subsector in transport and depending on the project. And that creates a real problem for planners, which is, which of my projects are well suited for PPP? How do I design a PPP program when in fact I have responsibility to invest on a whole network and a very interconnected system which needs to function as a whole? And by the way, as a public financier, I am shouldering the burden of most of this investment, even if the PPP program is very developed. The second issue is the one of demand risk, which remains rather difficult to manage. Now, there are many advantages of passing on demand risk to the PPP consortia, and there are varying policies, but the fact is it remains rather difficult to predict, and therefore, you know, very risky, very costly in that sense, as a risk to transfer. And the private operator often does not have a whole lot of leeway to influence what's going on. And then there are costs, because costs, I mean, we haven't spoken a lot about costs today, but costs are actually maybe less straightforward than you would think. Costs are extremely variable. They're variable between forecast and reality, and Peter Mackey was talking about optimism bias. And they're variable across different markets and different geographies, and this is a great concern. There is a question whether the PPP market has really enabled the public procurers to get the best costs out of projects. And I'm really talking about the physical investment costs, particularly when competition gets reduced to small numbers of large players, as tends to be the case now, where bidders are dropping out of competitions. And then the second aspect of cost is back to value for money is, okay, we have to absorb the extra transaction costs on PPP markets, and we must be very careful that that justification is still there with the real outturn costs that are coming out of the bids. And then finally, there's something which I would call maybe a planning risk, and which comes back again to the question of the public procurer designing a PPP program. I mean, too often we see public authorities thinking, oh, well, I have to come up with some kind of PPP program. Let me find the right project. And that's a bit a case of the tail wagging the dog. You know, you would want to see it go the other way around. So that tendency has existed and has created a certain level of concerns. Now, the issue is whether any or all of those risks are being exacerbated by the current circumstances, and whether, if that's the case, this is bringing us into territory where the whole PPP model is falling apart, or whether there is still a healthy PPP promise, at least on selected investments and investments that are, for example, the right size. We've seen a tendency towards smaller deals. Recently, there was the news of the closing of the M25 in the UK. This just a few weeks ago seemed almost impossible, and in a way is a very positive thing. And the question then is, well, what are the conditions for such large deals to close in the current market circumstances? How do governments, for instance, achieve that? And what might be the role of other actors, such as the EIB? So the European Investment Bank, which is the EU 27's lending arm, and as such is a public institution, is presently working on a vast array of instruments and facilities to try and bridge the gaps that we have identified in the market, along with other actors, and particularly with the European Commission. Of course, one assumption is that most of these gaps are temporary in nature, that there is a recovery somewhere down the line, and that the damage that has been done, for example, on the monoline industry, is something that maybe could be recovered somehow in the future. We also see that there's probably not a one-size-fits-all approach for all of the markets throughout the EU and for all kinds of projects. And this is due to different regulatory frameworks, and it's due to the structure of the banking world in these different markets. But if we've learned one thing in the last 2 years, is probably that there's a need for a lot of tools, a lot of flexibility to be able to face unexpected situations. So among those things, there are things that we have been doing, such as our traditional senior loans, and we will do more. We are doing more amounts. There are also loans at risk where we have no guarantees on certain portions. We are doing more. And then there's guarantees. We already have a guarantee window under the name of LGTT, which is the Loan Guarantee for TENS Transport. This is a very specialized tool which is part financed by DG TREN under the TENS budget, and which targets ramp-up risk for traffic-related revenues on PPPs. But we could imagine other guarantees. We could imagine direct guarantees, but we could also imagine the kind of guarantees that Gus MacDonald mentioned, which would be to try and replace some of the monolines activities. That is presently under study. There are a lot of issues related to that, as, for example, if the market is to recover, how then would the EIB exit that market and then pass it on back to a nascent new monoline industry? But there are also interesting questions of I wouldn't say conflict of interest, but playing on both sides of the fence, or crowding out even EIB senior debt if then on the other hand we are guaranteeing monoline insurance. So in other words, where is our value added best used? So all of these things are being discussed. There are other tools that are also under consideration, part of them in the equity world. We have received a mandate to study participation in an equity fund, and we are doing that. We are already participating in infrastructure funds as is, but then there are also other ideas about quasi-equity, different kinds of, even debt funds, things that the bank should be looking at. Which ones are actually going to get uptake from the market is a bit speculative at this point. If I have just 1 minute more, I wanted to come back on a comment that came at the end of the last workshop about the risk of concentration of investments on those areas that might be the more financially attractive. I think that's absolutely correct. There is definitely a risk. And I think it's correlated to another risk, which is concentrating investment on those areas where economic CBA is very high. Because if you base your analysis and priorities on bottleneck removal, you're bound to put your money where there is most traffic already. Now, there are counterbalancing actors here. One of them, and in a very major way, is the European Commission with DG Regio money investing massively in grant money towards the new member states over the programming period of 2007-2013. We at the EIB provide the same lending conditions to Romania as we do to France or to the UK. So in that sense, our financing advantage is also available to all of the member states, and I think that might help alleviate a little bit or mitigate those risks.
Thank you, Matthew. Just round up this with a brief final slide from Peter Mackey here.
Thank you very much, Chairman. There should be a slide. Here it is. I think the panelists have done a job on this topic, and I suspect there's going to be a lot of discussion, so I'm not going to cover ground that's already been covered. But so let me just make a few points surrounding one or two of these bullet points. In the middle 1980s, there was a top quality civil servant in Britain, Sir William Ryrie, second permanent secretary at the Treasury. And he made some rules for private finance in public investment, which were the birth of the Private Finance Initiative. John Major in 1990 made a speech in which he said something like, it's more difficult for a project to satisfy the Ryrie rules than for a camel to pass through the eye of a needle. In other words, the Ryrie rules were there to stop private finance, not to support it. However, my observation is that this private finance game has been a cyclical game. We've been through a number of stages in the cycle, and we're going to go through another stage in the cycle now, which Nicholas and Matthew have articulated very, very clearly. So I think the first bullet point simply says the starting point should be top quality economic appraisal linked to a clear and consistent funding plan. I agree with what I understood of Alan Bonafus's paper, that pricing, funding and investment have to be interlinked and have to be drawn together more intimately than they have in the past. I have a couple of technical questions in a way about Alan's paper. First of all, I think it's very important to define what the operating constraint, exactly what the operating constraint in the problem is. Is it the shadow price of public funds, or is it the shadow price of all capital? Seems to me that we've heard from the practitioners that private capital is, if anything, even scarcer than public capital right at the moment. So what exactly is the operating constraint? And then the second question is, how many years of the appraisal period do we assume that constraint is going to bind for? Do we assume it's going to bind for the entire period, or do we assume it's going to bind differentially for the next 5 years and then be slackened for the following 20 years? It makes quite a bit of a difference to the shapes of some of those functions and the conclusions. What precise constraint is assumed in the problem? The third bullet point says private finance should not be viewed as additional but an alternative to public finance. Now, that was written on the assumption that private finance is essentially mortgage finance, which needs to be repaid. Now, perhaps the point about equity subtly changes the condition of that particular bullet point, but only to that extent. I think everybody in the room probably understands the fourth point, and my comment in a way on what Nicholas said is that if the premium is too great, then you simply can't support it. And if the transactions costs have to be added on top of the premium as the cost of doing business that way, then the game is in acute difficulties. But the fifth point is a counterbalancing point, which is that maybe right at the moment we're in temporary difficulties in which private capital is not available or is only available on terms. What's going to happen a couple of years down the line? Do we believe that public sector discount rates, public sector opportunity cost of capital is really going to stay at these historically low levels? Should we be using time preference rates to decide on which projects we like, but then using opportunity cost to decide what the financing plan should be? I could imagine that a consequence in a couple of years' time, when we start recovering and we move into the next phase of the economy, is that we decide that the social opportunity cost of public capital is higher than we have said for the last 7 years. And it's the last 7 years when the PFI has really been in difficulties, because it's been so difficult to beat the public sector comparator. If the opportunity cost of public capital is increased, perhaps that gives more of a chance for private to be able to compete on level terms. But, second bullet point, it must add real value. Otherwise, why are we doing this?
Thank you. Now,
Yes, maybe a bit boring, but I would like to underwrite some of the earlier statements and maybe respond also to Matthew's comment or question about the PPP models maybe falling apart. I don't think the PPP model is falling apart. I think it's here to stay. Changed conditions might make it, well, as demonstrated by Mr. Rubio, changed conditions might make attracting private finance very difficult, but also public finance is in dire straits. But I feel that the core benefits of a PPP approach under this crisis are not challenged. And these core benefits are being an efficient delivery in time and budget of a public service. And I think the gentleman from Infrastructure Australia could well support me when I quote a study done in Australia about comparing PPP projects with traditional contracting. I don't know how many projects were compared, but it showed very clearly that in terms of budget, PPPs had much less cost overruns, really significantly less overruns than traditional contracting, and were much more in time in planning. And there's a growing body of evidence that shows that PPPs are there to stay. But it's an alternative next to traditional contracting. That's what I always how I present PPPs actually. The second point I would like to make is, if this crisis does anything, and maybe also demonstrated by one of the last slides of Mr. Bonafou, is that it focuses everybody, whether public or private financiers, on the golden nuggets, as mentioned in the paper of Mr. Mackey and Cochrane. So there's a healthy quality and rationality focus, I think, going on. Actually, a question I would like to raise with my co-panelists is, we've heard that all types of financing, whether public, private equity, private debt, is extremely scarce at the moment, difficult to obtain, and tough conditions. What non-financial support could governments set up to ease this? That's a question I would like to leave with my co-panelists. I would like to raise a last point, maybe a bit out of the discussions we had so far, I read a recent article, something I think it's one of the infrastructure finance magazines, that many players in the PPP market see the current crisis as a blip. And whether it will recover in 2 years or 5 years, it's a temporary phenomenon. And a main question for successful PPPs is still the capacity of governments to deal with them. Many players are calling upon governments to keep on or start investing in this capacity to deal with PPP projects.
Thank you, Caroline. Just on the question of the government's capacity to invest in infrastructure, I see Barry Stevens from the OECD has been working on what seems to be a widening gap in infrastructure need between now and 2030. Barry, your reflections on this and where the money might come from in the private side to help bridge this widening gap?
Yes, thanks very much, Chairman. About a year and a half ago, we produced a report at the OECD on infrastructure to 2030. And we were looking at rail and road, water, electricity, telecommunications. In other words, a selection of infrastructures, not all infrastructures. The idea was really to look forward a couple of decades to see, first of all, what were the investment requirements, globally speaking, over the next 20, 25 years. And we found that they were actually, for these sectors, rather high. As you can imagine, we're looking at global figures of something like 3 to 3.5%, 4% perhaps of world GDP. But we were also interested in what are the possibilities, in fact, of financing those potential requirements. And the key finding, I think, of the report really was that it's going to become increasingly difficult as we work through the next decades to finance infrastructures from the traditional public sector sources. And this has, of course, largely to do with aging populations, the pressures that are building up on welfare systems, pensions, health, and so on. Environmental pressures, again, reaching the aspiration to reach the ever higher environmental standards, climate change, and so on and so forth. We've touched on some of those things this morning. There are essentially, I think, 3 ways of going about that, and to rather simplify things now somewhat. One of those is to say, let's try to squeeze as much efficiency out of the system, perhaps, as we can. Let's see if we can improve demand management. That's one. Another area is then to say, right, are there perhaps other areas, other now than the traditional public sector sources where we can find additional financing? And I mean there are things like long-term infrastructure funds, greater use of user fees, and perhaps land value capture, this sort of thing. And then thirdly, and that's where we come to the subject of today's discussion really, what about involving the private sector to a greater extent? And here, we're looking at PPPs, but we're also looking at other areas. And one was mentioned, I thought was actually quite interesting, that's pensions. To what extent can pension fund assets be used for infrastructure investment? OECD-wide, we're looking at pension assets of around about $18 trillion. I mean, it's quite a lot of money there in pension funds. Those are the private pension funds. There are then the public pension reserve funds of around about 4 to 5 trillion, which come on top of that. So we're looking at quite a lot of money there potentially. But the bulk of that, of course, goes into bonds. Some of it goes into equities. And in fact, only a very small portion at the moment goes into infrastructure investment, which is a little odd, perhaps, because what we see there is, in fact, rather a good match in profile, if you like, between the investment and the saving in terms of long-term steady returns and relatively safe returns, in fact, and diversifying risk. But we did find that things are changing. on the pensions front and on the pensions of pension fund managers to invest a little more in infrastructures. So we have a number of countries who are getting more involved in this. These are countries, Canada, Australia, and so on, who are either opting to go into infrastructures directly by taking shares in utilities and so on, or who are working through funds. And then we also have, on the regulatory front, we have seen over the last few years a relaxing of regulations concerning the limits to which pension funds can actually put their assets into equity. And then we have, thirdly, a completely a counter trend in a sense, in that we're seeing a number of countries actually tightening up on their regulations in order to try to reduce risk exposure and vulnerability to a lot of the risks that are associated with equities. So I think my conclusion there really is that we're looking at very considerable potential there in terms of funding, but my sense is that the regulator is going to play quite a key role in whether that in fact comes about or not.
Well, thank you very much, Barry. And of course, as well as pensions, you've got the insurance industry and indeed sovereign wealth funds coming in. KL?
I think the debate has been going around the experience of PPPs in the OECD countries and in the European context. One of the reasons for globalization has always been the arbitrages that have taken place in terms of wage arbitrage, finance arbitrage, or knowledge arbitrage. It is this arbitrage that has been making the foreign direct investments, be it in China, be it in India. The pace of these foreign direct investments is slowing down, but I find there is no reason that this will not pick up. In countries like India, massive investments have been made through foreign direct investments in ports, in the shipping industry, as well as in the aviation. And Waleed was involved in the private sector development of the port at Bangalore. The only small issue is that whether the private sector or the foreign direct investments, which have also been coming into the auto industry, etc., will they come into the fixed infrastructure? That is, developing the rail lines, developing the roads, etc., which had traditionally been developed by the state. And I don't visualize that in the long term they will do it. Having said that, there's one more thing, Mr. Chairman. It is these very countries like Korea, Japan, China, India, which are Malaysia, which are having a huge reserves of foreign capital. Foreign currency reserves are there. Actually, they are the holders of the largest reserves. And it is a twist of history that these are the very countries which are bailing out the American economy in the terms of they are the ones who are forced to buy the treasury bonds of the United States. Now, it is in this context I was wondering that shall we not have a mechanism where these foreign exchange reserves could possibly be utilized for the development of the infrastructure? Some mechanism at the International Monetary Fund level or other should be possible. Caroline made a point that what can the government do in this downturn? And the government, to my mind, can give guarantees in terms of risk of traffic, risk of revenue. That's one way of doing it. The government can also assist in terms of renegotiations. There are several ways the government's role can be leveraged. We have been talking of the leveraging of the equity. If it has dried up, as I started the presentation in the morning, it is the political economy, the role of that leveraging, if we do, I'm sure possibly the way out lies over there. Thank you.
Thank you. Microphone down here, yeah.
Hi. So My name is Lou Thompson. I've been in the business of transportation investment planning for a long, long time. I have to use it. Okay. As I listen to this discussion, my main reaction is déjà vu. I suspect I've heard this kind of discussion, this cycle from the bottom to the top to, what are we going to do to, now we all know the answers, a lot of times. And what it boils down to me, is risk. Because that's what determines what we will do and how we will do it. And yet, you can't forecast GDP accurately more than what? Right now, 6 months, a year, 2 years. No one would believe a 20-year forecast of GDP. No one. And yet, transport investments are 20 years, 50 years, or even longer. So inherently, we're making investments beyond our ability to predict what that investment's going to be used for. We can't do that. Also, as Peter said, there is an automatic bias in the public sector on cost and demand, by the way, so that we know that we don't know what we're doing, and we know that we're probably going to do a lot of the analyses wrong. So what it comes down to is risk. Where is the risk, and how do we define the risk, and then where do we put it? And that's easy to say, but we have failed continuously at doing exactly that. The question that occurs to me in listening to this discussion is, what have we learned about risk, the definition of risk and the allocation of risk, that we haven't known all along? Is the game changed in any significant way in terms of predicting risk or measuring it or analyzing what's likely to happen in any given project, or are we still in the same position that we've been for the last 30 or 40 years? Are there any game changers, or at least game improvers, in this issue of defining risk and deciding clearly who should bear it? My experience with the private sector from the public sector is that the private sector loves to invest if the public sector will take the risk. This is a given. As soon as they have to take the risk, they take a very different approach. And we say that one of the benefits of the private sector is that investing their own money, they do a much better job of assessing risk than the private sector than the public sector does. But how do you get them to invest their own money?
Well, one very direct way of doing that would be through privatization, with strong regulation ensuing. And that's a transfer of risk, which I think certainly in most contexts would be seen to have been pretty positive. Just for background, it's reckoned now by the OECD that over 100 countries have privatized assets and have raised 1.4 trillion, I think, over the last 3 decades. So the question is now, with very weakened balance sheets for governments and a fiscal squeeze on, should we see more privatization, particularly in those unlikely strongholds of capitalism like the United States, where they still hoard a lot of their transportation into the public sector? Is that not better to be put out into the market?
Thank you. I think this is being a very interesting discussion, and I would like to comment on different things that have been discussed. Caroline, you put the question to the panel on non-financial support by governments. I think that's a very good question, but let me first talk about financial support by governments. It is funny because the governments are making huge efforts to support financially the banking industry, hoping that the banking industry is going to turn to the industry and support the industry, and that is not always happening. So I do think that maybe the public sector has to support temporarily directly the private sector, not through the banking system. And this is what I was mentioning before as an example, what the HM Treasury is doing, taking the role of a banker. And I think they are as well addressing one of the issues that Matthew raised, which is their ability to exit the projects. Because if they take a role on a pari passu basis as one other member of the syndicate, then as soon as the market improves, they will be able to quit. And in fact, what I've heard from them is that their intention is to close the unit they have created for this purpose as soon as the economy is back to where it was. But going to your question, I mean, we do think that this is not like a storm, that there's not anything we can do to help solving it. We just have to cover ourselves. And no, there are things that public authorities can do. And it may be déjà vu, but things continue being unsolved in many aspects. One, I mentioned before the question of things like the overall caps that central banks are putting on some developers and counting, regardless of whether debt is with recourse or non-recourse to developers. That is an issue for many infrastructure developers. I mentioned accounting. Accounting is not reflecting reality in 30 or 40 years investments. And the difficult thing with this is that the international accounting standards have been set 1 or 2 years ago. So it is incredible how can that be accepted, and it is very difficult for the private sector to develop its business showing huge amount of losses, because again, what is interesting is primary projects, is greenfield projects, and you can, I mean, and that is a problem. Other things are that were mentioned here, encouraging pension funds to invest in infrastructure, and I think that was a very good point. And that, for us as developers, is a huge point for becoming investors in developing economies. Because one of the problems of investing in developing economies is the uncertainty of the political behavior on the long term. And having as a partner a pension fund, a local pension fund, is a huge, provides a huge comfort against opportunistic behavior by authorities. So I do think that there is a funny thing that is happening with pension funds, is that some of them are now getting more sophisticated and willing to invest directly in projects, but most of them are investing through other funds, so funds or infrastructure funds. And that is in the last project we were awarded in the US, one of our partners is the Dallas police and firemen pension system. So that is happening, and I think it's going to happen more. And finally, one thing that governments can do, and it touches on a comment that Stefan made at the beginning, is the timing for projects going shovel-ready. We have seen I've seen in Spain, in Madrid, projects where the political decision of starting, of building a project was taken, and the ribbon was cut within a 4-year term. So it can be done. There is a huge amount of that delay that is due to authority delays in authorities, in permits, in approvals. And those are things that can be done and do not have a financial impact on the authority.
May I just answer very quickly concerning Lou's question? I don't think the types of risk have changed, but the levels of risk have changed. And that some have gone up, some have gone down, and that requires a rebalance between the role of public and private sector. So it's a very dynamic process. I thought that was a very good question, Caroline, and I think from our perspective, if governments can be less dogmatic about the inputs that are required for concessions and focus more on output, so an output-based model that says we need you to provide the following services under certain conditions, service levels and so on, and less about we need this capacity to be built for year 40 today, then I think that will help a lot. There are a lot of distortions, primarily concerning liberalization and open skies, and that adds a lot of cost to the system. And if we can go towards a more liberal, less constrained environment, that would be good. And also there are certain aspects in our industry, air traffic control, which also impose a huge amount of congestion costs on airports and airlines. And if there can be sufficient public investment in those aspects of our industry, that will help us quite a bit.
It's just on that, I was Minister for Transport in the UK when we privatised the National Air Traffic Services, and it seems to have worked out pretty well. It's more efficient, it's more profitable, and it looks to be safer. And I had assumed that because of the logic of that industry, where you can run the whole of Europe with 2 centres in Siberia and Ireland if you had them, why did we need 40 odds? But of course you're dealing with the irrationalities of national pride and irrational fears for security and so on. So at great cost to Europe and to the passengers, we've still got this patchwork of national areas. So what do we do about that, do you think? And just in the aviation sector, is it true that about 90% of airports are still in public hands rather than private hands? I see the Chinese are planning to build 100 regional airports in the next decade.
Yes, I think that there are many airports that will not be justifiable for the private sector to invest in. So I think there is a public role that airports do play. But certainly there are a huge amount of opportunities for the private sector to be involved, whether it's a management contract or a major investment or a minor investment. I think there are many varying degrees of participation. But yes.
So it seems to me that as we reach our conclusion, we really need a debate too, not just about where the risk is best placed, but where the private sector can be best involved. I don't think any of us would dispute the very important role of the state, and I think the state will have to continue funding the great majority of investment in surface transport. But there are areas where the private sector has begun to prove its worth over previous decades. And let's remember how nascent, how new some of this area is, as the PPPs. It's just really been the last decade that they've taken off in the United Kingdom, which has done more than anybody else, I suppose, with 640 closed deals worth about £64 billion to date. A lot of mistakes made and a lot of lessons learned. But even in infrastructure, if you're interested in pension fund investment in infrastructure, I recommend an OECD paper by George Inderest, which you can get from the OECD, brilliant on the pros and cons of it, but just reminding us that one of the difficulties for pension funds is infrastructure is hard to define in market terms still. And we don't have a lot of evidence yet in terms of the conservative financial planning of infrastructure funds or insurers on where best to invest. But I think one of the most important things to try and develop is a break with the political sense of the past, which I think Nicholas referred to, which has been, well, we may have to do a PPP, we may have to bring in private money because it's the least of all evils, rather than saying this is a proper partnership. The private sector does a brilliant job in many sectors of life. Why not in the delivery of our essential services, and get away from the apologia that infects so much of political response to it? So just take final points, very quick points around the table, starting with Robert.
Thank you. Just a few points on risk as a result of having looked at some PPPs which have not been as successful as was hoped. First of all, I feel very strongly that the rates of return, the discount rates that we used in our social cost benefit analysis in the UK, for example, are too low. They're of the order of 3%. That bears no relationship to the threshold rate of return which would equate our public budget with a basket of infrastructure projects. It also is worse than that. If we have projects which run for 40 or 50 years, a 3% rate of return means that we can almost guarantee that a project will succeed in passing this threshold, which leads to the politicization of the final choice of projects. If that went up to 6%, and I think that's about the right sort of level, it brings it into line with a private sector with a higher rate of return, which is commensurate with the transfer of risk. That brings us on to the second thing, which is the allocation of risk. I've been absolutely appalled by the structures of most UK PPPs. I think that it's partly because political pressures have led to those structures, but I think that Caroline said one of the most important things. Procurement in the public sector is appallingly low quality. And if we are going to have more private sector projects, we must make sure we don't have projects like Metronet, where a consortium was allowed to be undercapitalized, to have no parent company guarantees, and to subcontract all the work to its own members. Now, that should never be allowed. That one of our largest PPPs in the UK should be so appallingly structured suggests to me that, first of all, we've had poor procurement, and secondly, the political forces have been too great. We've got to break out of that for them to be successful. Thank you.
Any other?
I just want to add one point, which has been made, but maybe not strongly enough. Regulation and predictability of regulation is key for infrastructure investment, and key especially for infrastructure investment with private money, because we have a 30, 40-year horizon on infrastructure investment if you look at the business case, and regulatory rules in any type of, in any form, like procurement, construction, or fee setting later on, is not predictable, and it can really stop infrastructure development, as we can see in power generation in Germany, and in the grid development, which is lacking behind because of poor regulation.
Bon, en entendant tout cela, je me disais vraiment que si cette même discussion, même sujet, même objet avait eu lieu il y a un an, je pense que les propos seraient très différents. Et mon hypothèse, c'est que si elle avait lieu dans 2 ans,
well,
les propos seraient aussi
let
très
me
différents.
say that I have the following hypothesis on this. Had the crisis happened 2 years ago, our views on it would be very different. In other words, the whole thing is very complex and at times very simple. You always have supply and demand, and those are hard facts. Here we're talking about long-term demand, long-term supply, and the supply is at a standstill because of the risk that exists. Possibly in 2011 there'll be long-term supply and offers on hand, and you have maybe 25 years timeline for some supply offers. There are pension funds that are of great interest. There's not much of a risk to invest, and ensuring the risk using an inflation index, I'm sure we'll have this kind of an offer again. And so you have to make a distinction here between the short-term situation. I know I don't have the time to explain this, but in 6 months' time, major changes can happen in terms of risk management. And I think, nevertheless, something is reversible, things are reversible. We'll be coming back to very ordinary quotidian risk management situations. So let's just take a more optimistic look at the situation.
I think, Mr. Chairman, the role of the international financing institutions becomes important in this context also. They are the ones who are sitting on a huge pile of money. They also have the capacity to leverage from the market. To that extent, this liquidity scarcity which was being talked of could be, the gap could be filled in to that extent. The other thing is access to the pension funds was mentioned. It can be put into a kitty which can be managed by the financial institution. And I think a dedicated financial institution for development of infrastructure alone could be the answer to the countries. That way, The government can transfer the funds to that extent. Banks can participate. The pension funds can come into that. And those financial institutions will be able to leverage a huge amount of liquidity from the market or from the banks. Thank you.
My answer to Lou Thompson would be that there's a class of projects for which a significant risk has always been prior political commitment. In other words, the politicians get ahead of the economic assessment and funding and financing game and find themselves in a corner that they find it very, very difficult to maneuver away from. And in that context, just at the moment, I'm quite worried about mega projects. We were having a discussion with Stefan from the perspective of DB. If you have a great long list of projects and you need to draw the line in a different place, then robustness is perhaps not such a big issue. But if you have one mega project which the country is trying to decide whether to do or not, then prior commitment can lead to misunderstanding, political loss of face, a great deal of things that you don't really want to happen, and can lead to great difficulties. And I think that is a concern just at the moment. My old guru, Chris Foster, once wrote a book, Politics, Finance and the Role of Economics, and I think the game remains the same.
Well, thank you, Peter, and my thanks to all our panelists for their insights, and my thanks to the contributors from the floor. I'll report the key points of this workshop to a meeting at 2:30 tomorrow. It's in Hall 3 here, and we've got ministers from major nations and some representatives of the companies as well, discussing public and private roles after the credit crunch. So do come along to that if you can. Thank you very much for coming along.
For chairing the session so brilliantly. Thank you very much.